We've mentioned that shorter duration patterns, shorter than even the triangle patterns that are commonly found as continuation patterns are flags, pennants, wedges, rectangles. We've also mentioned that the head and shoulders continuation pattern will be discussed along with the head and shoulders reversal pattern. So let's begin discussing the key features of flags, pennants, and wedges. These patterns are preceded by a sharp up or down move. The market now is basically briefly pausing before running in the same direction. So in a rally, we're assuming that the market has broken out from some consolidation phase to move up higher, almost vertically. And because the move has been so sharp, the market will briefly pause. Now in this brief pause, the market forms a pattern such as flags, pennants, and wedges. Now this is where consolidation takes place, so the prices pause a bit, and this is where the longs can initiate their positions, or those who are still bearish, the shorts, will offer to sell on the upside towards the upper line. So the flag is a parallelogram that tilts against the prevailing trend. In a downtrend, the flag tilts upwards, and in an uptrend, the flag will tilt downwards. The pennant resembles a small symmetrical triangle but lasts for a much shorter duration, no more than 3 weeks. Both patterns should have a duration of 1 to 3 weeks. Volume should be very thin when the patterns are forming and very high during breakouts. The two patterns are known to usually form about halfway to the target, and therefore the distance covered post the breakout will equal the size of the flagpole. On the breakout, the trend will tend to replicate the flagpole. So next we talk about the wedge. The wedge is similar to the symmetrical triangle in the intermediate trend category. Unlike the symmetrical triangle, the wedge forms a noticeable slant against the prevailing trend. Therefore, a falling wedge is bullish and a rising wedge is bearish. If at all there is a rising wedge at the end of a rising trend or a falling wedge in a bearish trend, it could signal a reversal pattern rather than a continuation pattern. We also look at rectangles. Now rectangular patterns are easy to spot as it is formed when prices move sideways in an area between two parallel lines called the trading range. This pattern could be the formation of a continuation as well as a reversal pattern, and therefore care must be taken when trading. Traders also trade the prices within the range, selling on the top line and buying on the bottom line till the breakout occurs. Keeping a watch on volumes can give a better indication of where the prices can break out. Higher volumes on an up move can signal the breakout will be on the top line, and higher volumes on the down move can signal that the breakout will be downwards. Rectangles typically fall in the 1 to 3 month category patterns. The price move measurement follows the same concept as other formations and is based on volatility. So you measure the height of the rectangle and project that from the breakout point, giving the minimum distance prices should travel. So that's about it for continuation patterns. We look at the head and shoulders continuation pattern when we discuss the head and shoulders reversal pattern. And next we go on to discussing reversal patterns.